Hello and welcome to the How to Trade Like a Pro podcast. I'm Wieland Arlt, and in this episode I welcome Zaheer Anwari and we talk about trend following and the best strategy and idea to really get money for your retirement on a constant basis. Before we start, please take a closer look at the risk disclaimer in the show notes, and now have fun. I'm here with Zaheer Anwari. Zaheer is from London. He's a trader, portfolio manager, and of course, he's also a teacher for trading, technical analysis, and of course, for investing. Therefore, Zaheer, I'm very happy to welcome you in my podcast, and I'm really excited about our dialogue. Welcome.
Thank you for having me. I'm really looking forward to this conversation.
Absolutely. So just to jump directly into it, usually typical question I like to ask, and like everybody likes to know as well, is how it all started. Usually people don't just, they don't fall from the sky being a trader or investor. So how was your journey?
Yeah. So I guess it gets interesting once I graduated from university. So I'll spare the pre-university. I've got a very stable upbringing, if you like. Mum and dad brought me up. I got a sister, grew up in London. Yeah. I'm lucky. I have a very, very stable upbringing. University, slightly different story. Ended up studying software engineering, which now when I think back on it, I would love to have studied something different, but hindsight's a great thing. Graduated, worked for a year as a software engineer, and I, just like university, I didn't enjoy it. So what my first bit of advice to people is, make sure you end up choosing a 9-to-5 career that you thoroughly enjoy spending time doing, because it's the bulk of your day. Money will come, but ultimately it's the time of the day that you have to really focus on. So, choose something you enjoy. And if you don't, like me, change. So I did. I became an English language teacher, TEFL, teaching English as a foreign language, lived out in Asia for a couple of years, teaching English, Taiwan, had a beautiful time, but no money in it. And money was always a focus for me. I wanted to find that balance between a career that I enjoyed, time, and ultimately money coming through as well, because especially living here in London, you've got to have money.
Oh, yeah.
So came back, ended up being a photographer, working in photography as part of a collective. We did a lot of interesting projects, high-end advertising, editorial work, luxury brands. That's really where the money is, particularly high-end advertising. If you get money on the side of buses, for example, lots of repeat business coming through. That's really when the money for me started coming through. So when the money started coming through, I thought to myself, right, what am I going to do with this money? Typically, people go down the route of buying a property. And, I had quite a lot of money saved up. By the time I was 25, 26, 27, I'd saved up a fair bit of money. So instead of putting it into property, this is where my journey started with trading and investing. Now, as everyone else, day trading was the route that I went down initially. Paid a lot of money for courses and ended up losing a lot of money, because for me, day trading is a very challenging approach to the markets. Yes, you may be able to make money, but you've got a lifestyle that goes with that, which is challenging. You're glued to a screen. You may be working 9 to 5. When I was in photography, I was working 15, 16 hours a day. So to day trade alongside that was near impossible. So day trading didn't fit with me. I didn't make money. It didn't fit with my lifestyle. Then I started looking into people like Warren Buffett, came across value investing, started buying shares. Just felt a little bit archaic for me, fundamental analysis, looking into companies. It just didn't interest me. Then things changed. I discovered a book called Way of the Turtle by Curtis Faith. Oh, yeah. And I came across trend following. And that is when my mind just opened up to a whole new approach. I came across technical analysis. I came across long-term investing. So it was this beautiful combination of looking at charts to make your decision, but holding your positions like an investor. So it's kind of like a hybrid, which fit really well for me, because I was working long hours, do my analysis at the weekend, hold my positions during the week, get on with life. And, that's really when I haven't looked back since. It was just a real pivotal moment in my life. So Way of the Turtle, highly recommend people to read that.
Yeah, sounds interesting. I mean, this is I just you just talk about what you've been doing, and I was really like, did he just say like he was 25 at the end of his career? Yeah, I was studying at university. I was some years some kind of teacher. I did photography, and then I was 25. And I what?
Yeah,
So you were really speeding through.
Yeah, let's clarify that. I worked for a year. I didn't like it.
Right.
And when I worked for a year, that was during my university career. I did a sandwich course, right? So I worked for a year, graduated, became a TEFL teacher, lived out in Asia, came back, came back after a couple of years, landed in photography. Now, photography is where I started making a little bit of decent money. Now, when I say decent money, money that I could save. And that's really the starting point. When you've got money that you can save, that is when you can start recycling that back into your portfolio, into your investing. So by the time I started it, by the time I was able to save, I'm also, I've gone through various careers at this point. So money that I had coming through, I was never a big spender. I tried and saved as much, especially in my teen years as well. I saved a lot of money. I lived at home with my family. So I was in a blessed position. So by the time I got to say 25, 26, 27, that's really when I started coming across investing, started reading into things. But 27 is potentially really when I started actually taking positions.
Yeah. So thanks for clarifying, because I feel like it's very important for the people out there, especially if you're young. So your key message right here is, number one, if you really choose 9 to 5, go for something you really love. A lot of people, they mistake it. They just go for the money and end up, in therapy for that reason. Well, that's one thing. Second thing, what I hear from your words, use some kind of stop loss, which brings us to trading later on. But you just drew the line and said, okay, just give it 1 year, and if I don't like it, I just skip it. And this is also very important, because that's when you started investing with 25 to 27, you already had some insights on life, or some kind of jobs, in terms of, okay, do I like this or don't I like it? And I think it's very, very important, not just talking just always about, trading and investing. It's also about talking about life. What is good for me? What is my calling? And if you don't feel it, so why should you stick with it, right?
I totally agree with you. I think one of my blessings, I guess, in life was being able to just make quick decisions.
Right.
You know how they say fail quickly? And I think that's really important with your career as well. If you don't like something, you've got to make decisions early on. And I think, maybe in my early 20s, I was a little bit too brash. You're a little bit carefree. If you don't like something, you leave. By the time you get into your late 20s, maybe you are in a relationship, you may be married, kids, early 30s, then it gets more challenging to sort of just suddenly quit your career and move somewhere else. You can, of course, it's an interesting world we live in. There's a lot of opportunities online. There's a lot of support online. Even as an adult later on in your life, you can pivot careers. You can be a lawyer one day. You can be a landscape gardener the next day. You can pivot. But it's much easier early on in life when you don't have certain responsibilities. So, I just took advantage of that. If I didn't like something, I quit. Yeah.
And the last thing I just took from your words is that when you have some amount of money, and well, I don't want to go into details with everyone, but just for something to consider yourself as a listener right now, and as someone stuck maybe in between jobs, or what, not really know what to do. If you have some kind of money, it's always worth going for investing. And what you also just mentioned is, okay, you started being a day trader, which is typical, right? Yeah. So because just see the easy and fast money coming in, but also it's like at least 9 to 5, even though you're free to go and come and go the way you want, but you end up as a swing trader. I think this is a term we can use for that, right? Just and focus on also.
I would say trend trader. That's the trend.
Yeah, all right.
That's
my
trend trader approach. Yeah, trend following as opposed to swing.
All right. So I mean, we will discuss this also, because also here important to distinguish swing and trend trading, what this really means.
Sure.
But your focus is on some, let's say, days up to weeks, but not really like months or years, like like an investor. That's what I.
Well, 12 to 18 months is typically my holding period before I
Wow.
take profit or rebalance the portfolio.
Yeah. Okay. So I got you wrong, and thanks for clarifying this, because
No problem.
it's very important to understand this. That's why I'm figuring that out. But anyway, so your journey is from having something like a normal career, going over to, I don't like this, I try next one, I don't like this either, and then coming over from short-term to mid-term trading. I think that's what
Absolutely,
fits
that sweet
most,
spot.
right?
I agree.
Yeah. So, and this is also something, because that's why I have this podcast, to give some impulses to people to always to rethink your life, your work, everything you do, your professional career, and then find something else. And trading and investing is something you can do. You don't have to be a day trader. You can be if you like, but you can go other ways. And that's what I really like. And I like to go just for a little word about, this value investment like Warren Buffett does, because a lot of people just focus on that. Be like, okay, I want to be Warren Buffett.
Yes.
Of course, nobody can do. And I always like to say, okay, you can use this as a role model, but never forget that whenever Warren Buffett goes into a company, he's really acknowledged, and also he's like on eye level with CEO. And whenever something goes wrong with his investment, he has a straight line to the CEO kicking ass. Nobody of us can ever do this. So trying to compare ourselves with Warren Buffett is like a little bit tricky, I guess, right?
Yeah, absolutely. I mean, look, Warren Buffett's a legend in his own right. We can't knock what Warren Buffett has achieved, but we have to be realistic in what we can achieve in comparison. So first of all, if you look at performance tables, Warren Buffett is mid-table. Trend followers are at the top of performance table. So if you compare Richard Dennis from the Turtle Traders, if you compare his performance compared to Warren Buffett's performance, Richard Dennis has a far better performance history. He's got a better stock selection. He's made better annual returns. Warren Buffett, a big chunk of Warren Buffett's money that comes through is from dividends, which is, in billions on an annual basis. So what we have to, as everyday people, as everyday investors, what we have to look at is where we are right now, what we want to achieve, and what is the best strategy to achieve that. So reverse engineering the process is important. So let's look at some numbers. Let's say if you have £20,000 in savings, $20,000, £20,000, 20,000 euros, depending on where you are, that sort of ballpark figure, 20,000.
Yeah.
That's really when it gets interesting. So I would recommend that people save at least 20,000 before they start investing. So I'd save that. When I go back in time and I say, look, save money, I had 20,000 as a minimum saved. So that allowed me to experiment, try different things, try different courses, try different strategies. I had money coming through from the photography as well, so that I could always replenish my pot if I made any wrong decisions. So, I was in a strong place to go on this little journey of mine. But if you want to start with, let's say you start with 20,000, you want to make £1 million over 20 years, you can add an extra £100 a month to the pot. Your ROI, your annual ROI is 19.78%. Okay, so I'll just say that again, 20,000 as your starting amount. You want to make £1 million over 20 years. You can add an extra £100 a month to the pot. You need to be achieving 19.78% annually ROI to achieve that.
Yeah, so it's almost doubling everything, right?
Exactly. So the question is then, what are the best strategies to use to achieve this? And I found, then we have to throw in another mix. People are busy. You got a job, you got a career, you got family, you got kids, you got hobbies, you got social life. You've got all of this going on. I mean, as you should be. This is life. This is the beauty of being a human being. You're blessed with this opportunity to experience this world. But at the same time, you want to have these smart processes in the background where your money is growing and compounding away. And so that for me, is really where trend following comes into its own, because it's simple to learn and execute. If you compare that to value investing, it's quite heavy in the research process, whereas technical analysis is far simpler. Mm-hmm. Also, you've heard the expression to catch a falling knife. Yeah. Value investing, if you think about it, really is what you're looking for is a stock that was expensive, that's now cheap, and you want it to go up. Mm-hmm. Well, that point where you deem a stock to be cheap, it can actually just keep on dropping against you. So you buy this stock thinking it's going to go up, and it can keep on going down. This is a challenge that people regularly fall into with value investing.
For a reason, of course.
Yeah. Exactly. Whereas with trend following, you're buying a stock that's already going up, and you're going in the direction of the established trend. So there's lots of advantages to trend following over value investing in terms of learning it and executing it, and also the returns that are achievable over 10, 15, 20 years. Notice what I'm saying as well, still a long period, right? 10, 15, 20 years. You've got to have that outlook, that mindset, that vision. If you want it in 10 weeks, you're going to fall flat on your face. So be realistic.
Yeah. Also there's so many insights right here. When you say, okay, you gotta almost double your account like every year, literally it's impossible. You can do it on an Excel sheet maybe, but in real life, come on. Also, when you talk about day trading, everything is possible, right? But in practice, not so sure. So when you say, okay, let's go with trend following, and you have a holding period of, let's say, 18 months, 1.5 years. So this is a reasonable time frame. This is something where you can really just control things a bit, control your investment without having all the bad surprises. But still, it comes to mind, if you say, okay, I wanna buy all the stocks which are already going up. And so if I remember right, thinking about Torero Trader, which is Curtis Face from, one of the strategies was like buying every 52 weeks all-time on new high or all-time highs.
Right.
So as a trader, and I'm just going more for the swings, coming from the downside, just going up, looking for the upside. If you go with a breakout, you always have to deal with false breaks. So how do you deal with that?
Yeah, really, really good question. So all-time highs is a stock. All-time highs are stocks that I really like to buy into. Mm-hmm. But these stocks have to be broken out from a consolidation, a base. So what I typically look for are 4 phases. Phase 1 is a history of performance. It's already trended well in the past. This is a technical analysis. If a stock has trended well in the past, it's very likely to trend well in the future. It's simply about probabilities. Mm-hmm. So that's phase 1. I look at the chart and I go look for a period where it's trended well. If it's trended well, great. It's very likely to trend well in the future. Look at stocks like Microsoft, for example, beautiful performance history. But not just Microsoft. There's a lot of obscure stocks out there with huge volumes, 1, 2, 3, 30 million. For example, Hub, HUBB. This is in our portfolio right now. Hershey, the chocolate company. There's stocks that people overlook because you don't really hear them in the media, right?
Right.
So phase 1.
It's not really exciting talk about chocolate anyway, nowadays. But you're right.
Exactly. Everyone's talking about AI, right? There's always a sort of something that the media likes to jump onto and really sort of bombard us with.
Yeah.
And that's where you as an individual have to be a little bit more savvy and go, well, actually, what else is out there? It can't just be AI. There's 11 sectors. Consumer discretionary, industrials, materials, all those other beautiful sectors. So for me, sorry, I've digressed here a little bit. One of the first steps that I do is I scan sectors. I have professional scanning software that I pay good money for that scans sectors based on a particular criteria that I programmed into the scanners. One of those criteria is, has the asset performed well in the past? So it will pump out all of these stocks that have got a good performance history. Then what I'm looking for is a consolidation. So you know the expression, the longer the consolidation, the bigger the breakout.
Yeah.
So
true.
If a stock has created a long sideways market, a long consolidation, think of it as the roots of a tree. The stronger the roots, the bigger, the taller the the tree will grow.
Love that.
So if you've got a long consolidation that's over, I look for at least a minimum of 3 to 6 months, minimum.
Mm-hmm.
But that consolidation could go on for years. I mean, look at gold. Gold has been in a 13-year consolidation, right?
Yeah.
If gold breaks out, if it ever breaks out, you can imagine how big that trend could potentially be. It could go on to $4,000, $5,000, who knows? But for us to actually see that happen, it needs to break out of consolidation first. So that's phase 2. I look for that consolidation. Now, to answer your question, which is how do you avoid a fake out?
Mm-hmm.
Really simple. Never buy into a stock on the first breakout.
Yes.
The first breakout is often where the market may reverse against you, suck people in, market goes against you, you get taken out of your position. So it's really simple. Just have these filters, these very simple filters. And this is something that used to happen to me a lot. I used to get in early only to be stopped out because the market would go against me, fake breakout. So I thought, okay, what I need to do is apply patience. Patience is an art that is often overlooked. So instead of getting in on the first breakout, wait for maybe the second breakout or the third breakout. Now the odds of the trend continuing are much greater. Very simple filter.
Yeah, exactly. Because, that was the reason why Linda Reschke came out with a turtle soup strategy, which goes exactly for that one, for the false breaks, like going into maybe mean reversion, but of course in the opposite direction. And it works out well.
Yeah.
So yeah, I love the idea of never go with the first breakout. So see, okay, something is happening. We saw this in the indices recently, especially in the DAX, we had a new all-time high. And as we speak, we have July 2023. So we just went into breakout just to see that just after a few points going up, everything went down. And you don't want to be that guy, right? You just want to be somewhere where like, okay, let's try again. Or you want to go, maybe, please correct me if I'm wrong from your point of view, but maybe you want to go with going a little bit deeper and just buying into the next move, just facing the resistance or facing the all-time high, just be into it the moment it breaks out. So you have a little bit more distance to cover and already in profit the moment it happens.
Yeah, there's various ways of doing it. Of course,
yes.
I would say the most important thing is focus on your risk management so that if you are wrong, which there's always a chance of being wrong in investing. It doesn't matter where you enter in a trend. There's always a chance that the market that position will fail. There are no guarantees. It's only probabilities. As an investor, you're going in on a predetermined edge. You have to have an edge. So again, here's another saying. If you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. So you've got to have an edge and you've got to be able to identify that edge. For me, technical analysis is a beautiful way of identifying an edge. I've got my monthly time frame, my weekly time frame, and my daily time frames. I look at all three of them and I have a number of factors on each time frame. On the monthly, I'm looking at A, B, and C. On the weekly, I'm looking at A, B, and C. And on the daily, I'm looking at A, B, and C. If all of those factors are in play, my edge is present and I take a position. Now, here's the thing. Even when I take a position, I only risk 1 to 2% of my account on that position.
Yeah.
So I'm not emotionally attached. I know exactly how much I'm set to lose. And if it fails, so be it. It's 1 or 2% of my account.
Right.
So however you look to enter into the market, A, make sure you have an edge, but B, have really good risk management rules so that if you fail, it's a small loss.
Exactly. And also I'd like to, go into this number again, because you say that's 1 to 2%. And, this is the classic one. Don't go over 2%, of course. But, and this is also interesting and important to understand, that if you go really short term, this might be way too much, If you go long term, it's only fine, and especially if you're using a lever, this might kill you. But if you don't have a lever, just go really into stocks or ETFs, everything is okay, right? So just to make sure everybody understands this concept of applying risk and position size as well.
I think here's the thing. There's only one aspect of a position that is out of your control. and that is the outcome of the position. We have no idea what the market is going to do next. Zero.
Yeah.
All we can do is play on probabilities.
Yeah.
We have to make sure that we enter a market, and at that moment we enter the market, we have more chance of making profit than a loss. That's what is in our control. What asset we're looking at, when we enter, where we place our stop loss, how much we risk, the entry point, is on a breakout, is on a pullback. All of these beautiful aspects of taking a position are in our control. Mm-hmm. Once we're in, it's all down to the forces of the market.
Exactly.
So position sizing is essential to that, because you want to make sure that the most important part of position sizing is small risk, well-placed stop loss, but also you want to be objective, remove emotional attachment. Mm-hmm. And the way you remove emotional attachment is to make sure that you just have a small risk associated. As soon as you start allocating 5%, 10%, you're invested. Yeah, and you're constantly looking, oh my God, what's happening? Then there comes this element of wanting to be right. And it's not about being right, it's about making profit. Mm-hmm. So again, that's a different distinction.
So as a trend follower, I assume, and that's what comes to mind listening to you right now, you appear to be a buyer only. So it's a long only strategy you follow, or do you just short as well, just the way it happens?
Fantastic. Okay, so I'm both, but
good to know.
Yes, absolutely. But here's the thing: let the market dictate whether you're bullish or bearish. Okay, and a timeless marker. Again, I learned this from very early on in my journey. The 200 simple moving average on the daily time frame. It's a proven indicator. It's a timeless indicator. Institutions still use that logic today. Yeah. If the market is above, so I look at the S&P 500 as my primary indicator of the health of the market. If the S&P 500 is bullish, that is above the daily 200 SMA, above the weekly 200 SMA, we're in a bull market. If the S&P 500 is below the 200 or 200 SMA on the daily, 200 SMA on the weekly, we are in a bear market. If there is a mixture, we're in a sideways market or a correction phase. Yeah. So I started investing in 2007, 2008. 2008, of course, we had the correction when the with the financial meltdown. So a lot of people assume that I lost a lot of money in 2008, when in fact, I actually made a bit of money because I learned to short the market looking at the S&P 500 in relation to the 200 simple moving average. Okay. So I do both. Now, since 2008, 2009, I've been bullish. So last year in 2022, when we had that huge correction, 28% in the S&P 500, I was actually long on stocks like McKesson Corporation, ticker symbol MCK. Healthcare and energy, they continued to go up despite the correction in the S&P 500. So I'm not a perma bear or a perma bull. I hate those terms. I'm just simply aligned with the market. So whatever the market is doing, you'll find me in that direction, which is, if you look at the last 30 years, it's mostly bullish.
Yeah. But how do you deal with short-term corrections? We had just for 3 weeks, we had this 2020 Corona crash that's going on like for 2 or 3 or 4 weeks or whatever, just literally having the market. And is this something where you feel like, okay, I'm going to sit through it? Do you exit? So where's your exit strategy with a loss? Or where do you just say, okay, I have to wait. I have to go to the sidelines.
Yeah, good question. See, think about Corona. Corona is a black swan event, right?
Yeah, of course.
So, and it's a really good point, Wieland. We have to assume that a black swan event can happen any day of the week. That's a black swan event, right?
Yes.
It could happen right now as we're speaking or having this podcast. We can turn to our charting packages, and the S&P 500 has dropped 15%. We have no idea when this will happen. So this all goes back to what we were discussing earlier, which is focus on what is in your control. As a good investor, you must always protect your downside. That is your primary objective. The upside will happen as you start making the right investments, particularly when you start compounding winning investments, the upside will take care of itself, but you have to always protect your downside. And how do you protect your downside? First of all, make sure that you have an edge whenever you enter an asset, so there's more chance of making a profit than a loss. Second, make sure that you risk small. And third, make sure you have a stop loss on every single position that you take. Now, I use wide stop losses. Again, I took this from my journey with the Turtle Traders and reading about them. You know, they used Donchian channels. I started using ATR, average true range.
Yeah.
Average true range will give you a stop loss that is unique to the asset that you're looking at. So, for example, Tesla is obviously far more volatile than Microsoft. So you would want a much wider stop loss. So ATR is how I calculate my stop losses, and that ultimately is how I protect my downside. So something like Black Swan event like Corona, I got stopped out of all my positions, as most people would have. But I walked away with a very small loss compared to a lot of funds out there that got hit massively, 50% plus in negative. That would never happen with my risk management rules.
Right. I mean, it's also very, very important when to cut your losses, when to exit everything, which is, okay, I'm done, I'm out. And, take the loss, even though it's a small one, it's still a loss, it affects your self-esteem a bit. It affects your definition of being an investor. Everybody asks stupid questions, all the stuff. But still, you have to do it because, exactly what you say, it might go deeper and deeper and deeper and destroy everything. And that's very important also to understand also how to apply. So you just put it as a hard stop, or do you use it as a mental stop?
Or again, really good question. Whenever I take my initial position, it's always a hard stop, always. Right. So now the whole idea of me losing more than 1 or 2% has gone.
Right.
But here's the thing, my stop loss is placed at a position where I don't get stopped out of swings. I don't get stopped out of pullbacks. A trend is not just green bar, green bar, green bar, green bar, green bar. That's what people want. Exactly. Right. A trend is a function of time. You have a move, you have a pullback, another move, pullback, little consolidation, move, pullback. A trend is a function of time. Yeah. So you need to give a trend the space and the time that it needs to develop. And the way to do that is to make sure that you have well-placed stop losses. If your stop loss is too tight, you will be continuously getting stopped out. So people get frustrated. Right. And to counteract that, they just completely remove the stop loss. Now you're 100% at risk. What you want is that, again, going back to what we were talking about, 12 to 18 months being that sweet spot of holding positions. You're not short, you're not too long. You're in that middle space. Same with stop losses. You want to have that middle ground where it's not too tight that you get stopped out too quickly, not too far away so you're holding positions endlessly. It's that middle ground where, okay, I'm not going to get stopped out as the trend develops. I need to give it time. But if it gets hit, I know that the trend has failed and that the market is reversing. Yeah. So every position has a physical stop loss. As that trend develops, then I may move to a more mental stop loss. But even again, that's more advanced. Yes. As I got more comfortable with my strategy over 3-4 years, that's when I started switching to mental stop losses. But in my early days, it was all physical.
Yeah, I mean, you can have both, which is pretty clever because the hard stop always is a lender of last resort. So, if that one gets hit, basically this needs to be at a point where your mind just gets out, where you feel like I'm not able to decide anymore because I'm so shaken from, emotionally wise, that it's better to have a hard stop who does a job for me. A mental stop, therefore, is way above, I guess, like where you feel like, I have the idea. I don't think it just goes any further. So this looks strange for me, so we just exit maybe a bit, part of it. And, just to make sure that you keep your profits as well. And speaking of, how's your profit taking? Because, when you go with all-time highs, when you just follow the trend, obviously, if you go to the left, there's nothing for orientation. So where and when do you exit with a profit?
Well, the simple answer is I use trailing stop losses.
All right.
the beauty of trading stop losses is that it removes the guesswork of when I should take profit.
Right.
Ultimately, as a trend develops over that 12 to 18 month period, the stop loss will follow.
Yeah.
The software I use is TradingView. Great little bit of kit, browser-based, excellent price. I mean, if you go back to the early 2000s, some of the software that we were using back then was extremely expensive, thousands of dollars. Today, fast forward to today, you've got lovely bits of browser-based kit like TradingView that is reasonably priced, a few $100s a month. A few $100s a year. And plus, it also has a programming language built in. I believe it's called PineScript, and that allows you to develop your own tools. So all the tools that we developed for all those really expensive bits of kit that we used in the early 2000s, we developed those tools for TradingView, and one of those tools is a trading stop loss. So as the trend develops, I have my trailing stop loss following. So just to sort of give people an idea, a visual idea, what a trailing stop loss is. Imagine if you're climbing a very, 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 very tall ladder. There is a safety net, that physical stop loss that we talked about initially, right at the bottom of the ladder. Now, imagine if you start climbing that ladder. Ideally, what you want is that safety net to be following you just by your feet. Right. So as you climb that ladder, that safety net is following. What you don't want is that safety net all the way down at the bottom. So once you do get to the very top, if you fall off, you've got to fall all the way back down. Okay, you've got a safety net. You're not going to die, but it's still a big drop. What you want, ideally, is that safety net just following by your feet. So as you go up, and if at any point you fall off, you've been caught by that safety net. Same logic with trailing stop losses. As the trend develops, as the stock starts moving up, what you want is a safety net or a trailing stop loss that's following. So at any point, the trend reverses, the trading stop loss will have locked in a large chunk of your profit. So it removes the guesswork and ultimately just focuses on allowing the trend to develop. Once it's triggered, we take profit.
Yeah, I see. I mean, this can be a good idea, just especially if you're going long-term or mid-term like you do. Experience from being an intraday trader, it's not really the same. So intraday, I just feel like we have a lot of sideways moves, Yes, of course, prices try to go up, they try to go down, they try to find a certain trend. But most of the time, from my experience, it's just, just moving a bit up and just stall somewhere, going sideways. And therefore, I feel like going more into swing trading on a short-term basis. But it's really interesting to, to compare both ideas and also know when to apply which, So if you go short-term, it's more for the swings. If you go mid-term, like months, it's more for the trend. Would you agree on that?
Yeah, absolutely. Absolutely. So then it all goes back to the very beginning, what we talked about, which is what are your goals?
Right.
Reverse engineer your process. How much money do you have? What do you want to achieve? What is the ROI that you need to get to that stage? What strategies will help you achieve your ROI? That's the first thing. Second thing you have to take into consideration is your lifestyle. Right. Are you busy? If you're working a lot of time, and if you're working long hours, maybe you're a business owner, CEOs, whatever the case may be, doctors, you may not have the time to be day trading and swing trading because it can be more time intensive.
It is.
Trend following is that sweet spot where you get excellent returns with minimal time in the week. It all starts with weekend preparation. Everyone has a bit of time at the weekend. Markets are closed. You've got plenty of time to do your scanning, analyze, build your short lists, manage your portfolio. And then once you've done your weekend analysis, Monday to Friday will take you a few minutes each day to manage your portfolio because you know exactly what needs to be done, what stocks you're looking at, how to move your stop losses, all of that good stuff.
Right.
So, it is a case of figuring out where you are right now, what you want to achieve, the lifestyle you have, and then choosing a strategy that fits best into that. For some, that may be day trading and swing trading. For other, I know from experience that when you get into certainly your 30s and you're married and you have kids and you have an established career, trend following will sit far better into your lifestyle
than most other strategies.
Yeah. Yeah, I agree. I mean, I'm a day trader by definition because, I'm self-employed. I just take care of my own. I'm just sitting in front of my computer. I have another screen with some software on it, writing emails, doing all the management stuff, and just, I have my software running. And also, I feel like it's a little bit also a matter of your, psychological constitution. Is like, can I really deal with 60% losers, or do you want to have a reward every once in a while, like 60% winners? So for me, the answer is pretty clear. I hate it to be rejected, right? So you really have to know what you're dealing with, right?
Absolutely.
How about you?
Absolutely. I totally agree with you. There's a lot of, day trading sometimes is like going rounds with a professional boxer, because you got to learn to take some real hits to then land that one punch where it makes it all worthwhile. And you've got to really be able to take some real jabs to the body to get to that stage. And you got to think to yourself, do I have the mental makeup for that?
Right.
Do I want to go through that? And if you're married and you have kids and you have a life, that will have a knock-on effect. If you're constantly attached to your positions, if you're getting stressed out with your trade, that will affect the relationships around you. It's natural. Right. You can't be stressed with your money and then have a normal, loving relationship with your wife and kids. There will be some kind of impact. So you've got to think to yourself, is that what you want? If that is what you want, go ahead. But I know from experience in our community, Sublime Trading, our community is catered towards CEOs, high net worth individuals, high salary. Generally, everyone in our community is married, right. Kids. They have a lifestyle. They've done the day trading. They're done with it. They want something that's a little bit more relaxed, but still makes excellent returns.
Yeah. Yeah. And I mean, there's also something everybody has to really consider. Of course, there's scarce times. They have a career, which is running already very good. Otherwise, if you focus on CEOs and, comparables. So, of course, there's always a decision to make. And the decision is always not just, I have like an 80-hour week, and then I go over to day trading in the night. It's totally ridiculous, right? So then it's better to, have a decent screening process, making educated choices, and go over to easygoing management. Maybe it also automated, like the stop loss just takes care of itself, gets trailed by itself. They don't have to care about this.
Absolutely. Yeah. And the thing is this also, you made a really good point. If you're going to be a day trader, you don't want to be day trading markets that have the least liquidity. So what's the point in day trading through the night when you're day trading maybe the Asian market that has the least liquidity? You want to be day trading when there is the most liquidity. So that will generally be the UK market, because that's the biggest Forex market, maybe overlap into the US market. But then if you're working in those hours and you're settling to day trade in the evening, you're just making things really, really difficult for yourself.
Yeah, for sure. So it has to be fit for your lifestyle, your personality.
Correct.
And also you have to choose a strategy wisely, because there are so many strategies out there. I follow mine, you have yours, and all of us have our strategies. And speaking of strategies, mentioning the turtle traders, I mean, why did they call them turtle traders? Because they just picked a few randomly and said, okay, this is, we had discussed this before we started this conversation. And it's like, picking people randomly, giving them one single strategy, and it turns out with total different results.
Absolutely.
From being broke to millionaire, whatever,
Yeah. Some were dropped from the experiment.
Yeah.
Some were dropped because they couldn't follow the strategy. So there is a big part of just being able to follow rules. Going back to the whole why they were called the turtle traders, I don't know how accurate this is, but because I've read that this isn't entirely correct. But when Richard Dennis and William Eckhart, when they had the conversation, when they took the bet, apparently they were standing in a turtle farm somewhere. I can't remember, but Singapore or the Philippines or somewhere like that. They were in a turtle farm when they had the conversation.
Yeah.
And I think that's where the idea of the turtle traders came in, because I think one said to the other that we will make traders like turtles. And that goes back to what you were saying. So
yeah, kind of like that.
yeah.
Yeah, it's true. And also, I mean, you also do your teaching, you have the strategies, people can learn from you. You have all the services we all can offer. So from your experience, what happens if you teach people your strategy? Are they really stuck to it, or do you feel like some individualization into it? Like, I feel like you have to change something. How is that?
Everyone is individual. And it's a really fascinating, it's one of the hardest things you have to deal with when you have a community is everyone's individual, everyone has a personality, everyone has their own psychological makeup that they bring to the journey, but also everyone has their own experience. What you will find is that men, mostly men, because they're the ones that have been sort of on this journey, there are more and more women getting involved, which is great. But men generally come with baggage. You know, they've been trading, investing for many years, some successfully, some not so successfully. So there's always that sort of baggage that they bring to the journey. And so for men, often it's a case of unlearning bad habits and relearning good habits. Some people are just easier at some people are just easier at letting go of these habits than others, because the expression is investing or trading is simple but not easy.
Right.
The best techniques are simple to learn, but executing those strategies again and again and again, being consistent, being resilient, it's not easy.
Right.
And
exactly.
if you've got if you've got bad habits, then it just makes things a little bit more tricky. Whereas women generally tend to be blank canvases. They're very process driven. So if you give them a strategy and say, hey, follow these rules, they're often very, very good at following those rules. Men, we've got testosterone, so we've got to learn to control that. And if you can control it, we're amazing creatures.
Yeah, I mean, well, I don't want to go too deep into this man-woman thing, but of course, it's very interesting, and I also always wonder, okay, where are the differences? Once in a while, I also have like an interview with with woman trader. I was in Australia. I was I was meeting Karen Wong. She's trading over there.
Yes,
and she's one of the most successful, not just traders, but women as well. But there are so less women in this field, and it's also different. If you go to Asia, there are way more. If you go to Europe, there's literally nobody. And I always wonder, why is that? Any clue?
Look, I think everyone can speculate. I think what's important is that now, whether you're male or female, the opportunities to get involved are the same. Here's the important thing. As long as you have the right money coming through, as long as you're in a right position financially, as long as you have the right savings in place, as long as you have the right mindset and outlook, it doesn't matter whether you're male or female. Right. What's important is adopting a strategy that works, that fits in with your lifestyle, giving that strategy the time it needs to learn and execute, and then staying consistent and resilient with that.
Yeah.
And going back to what I said earlier, if you have baggage, i.e. men tend to have a little bit of baggage, it makes it more difficult because you've got that internal battle that's always going on. And at some point, that battle has to go, right, I've got to let go of what I've learned in the past and just run with what Zaheer is teaching us here at Trendfollowing, because it's proven. We've got results. We can show results and we can say, look, this is what we've achieved. What have you achieved? Well, you haven't achieved anywhere near what we've achieved. That doesn't mean to say you're a bad investor. It just means that our strategy will get you better returns. So let go of your strategy because it's not as good as our strategy. Run with our strategy. So again, it's that battle of the ego. It's not about being right or wrong. It's just about making money. And the older you're getting and the closer you're getting to retirement years, the more critical this becomes, because every year that goes by means you're getting closer and closer to retirement without the right funds in place. So, it's just a case of doing what's right.
Yeah, absolutely true. on the other hand, and this is what I really love about trading and investing, you will never stop, right? So there is no retirement from the markets. Why should you? I mean, this is so cool because you're not just sitting day by day, hour by hour in your office, having meetings, all the stuff which is coming into it. You just sit the way you want on your computer in the time frame you're comfortable with. You do some decisions, you're still on it, but there's no need, right? And I really love this idea about trading. So everybody should be a trader in its retirement years, just to be busy again, or still be busy. What do you think about this?
I think you made some really good points. I think what is great about, particularly if you are slightly on the longer side, so for example, that middle ground that we invest in, one aspect of the strategy that we haven't really talked about in too much detail is compounding. Mm-hmm. And what makes holding positions for 12 to 18 months so lucrative is the ability to compound. So for people who aren't sure about what compounding is, it simply means adding more of a winning stock into the portfolio. So let's say you buy Microsoft at $150.
Right.
When it gets to $160, typically people take profit, mm-hmm. depending on your strategy and your win, what sort of risk to reward ratio you're working on. But let's say from $150, it moves to $160, you take profit. That's actually not the correct thing to be doing. The correct thing to be doing is actually buying more of that winning stock. So buy more. So you've still got that position open at $150, add more at $160. So now you've got two positions on Microsoft. Add more at $170, add more at $180. And then when it gets to $300 and the market reverses and your trailing stop loss gets triggered, you've exponentially grown your returns over that 12 to 18 month period.
Yeah.
And you can continue to do this for forever until at some point you decide, right, you know what, I'm done, I'm retired, I'm in my 80s or whatever the case is, I don't want to do this anymore. But what you have also done is you've learned a set of skills that you can then pass on to the next in line, your family. Who's going to look after the family wealth, right? Because the schooling system isn't going to teach you this.
No.
Financial literacy, exactly. Financial literacy is not part of the schooling system. The schooling system is great for building a career, going out into the big bad world, earning money, building a salary, whatever the case may be, but it's not good at teaching you how to manage your money. So you, as this generation now, with the technology we have available to us, it's down to us to learn the skills, have processes in place, grow our money to a point where we're comfortable, we're happy that we left something for our kids. But then also, what are our kids going to do with that money? Well, we've got to teach them how to manage that fund so that when we've moved on, they're next in line. And that's how you break that financial illiteracy loop. So people need to start learning this, because not just for themselves, but teach your kids.
Yeah, for sure. I mean, just crosses my mind. A friend of mine, she has a 11-year-old boy. He's really crazy reading my book about risk and money management. I feel like, what is going on over there? It's like, are you serious? Where's Harry Potter gone? But yeah, you can do both.
Exactly. Yeah. Don't take away his childhood, but start instilling good processes. I think it was Warren Buffett who said that. I think it was Warren Buffett who said that my first investment was at 11 years old. Before then, I was wasting my time.
Yeah.
So I think it was Warren Buffett. That quote always just makes me giggle. I mean, do both. Let kids have fun, show them what the world is about, but talk to them about money, talk to them about responsibility, talk to them about saving, all of these really basic principles, so that when they do get to adult age and they're earning money, they're already aware of what needs to be done. Right, I'm earning this much money, I'm going to put this much away into my savings account.
Yeah, exactly. So it definitely needs to be taught, it needs to be learned, it needs to be lived. And again, it's it's more like a life decision if you want. And that's also pretty cool about trading. You can go so much deep into this rabbit hole as you want. Or you just stay on the surface and just buy some kind of strategy, just follow blindly. So everything is possible. Love that.
The world is your oyster, right? The more nerdy you become about this, And you don't have to become overly nerdy. You know, you don't need to get upset because there's also analysis paralysis.
Yeah,
you overread, you over research, and you don't do the most important thing, which is execute. So you got to find that balance between understanding what you're doing. Because there's certainly an element of sophistication to good trading and good investing that people overlook.
Mm-hmm.
So you do want to get to that point, be nerdy about it, be sophisticated, but at the same time, enjoy life. Don't get overly obsessed with it. Just be smart, have processes working, get on with life as well at the same time.
Right, which brings us, so more or less to the to the end of the conversation. And usually I like to, and you, because you're already into it, I really like to ask you for your advice for novice traders. So people who just really want to start with this, let's say, making money on the stock market, no matter if it's day trading, swing trading, more long-term or mid-term view, like trend following. So what is your best advice for them to start?
It's a really tricky one because
it is.
Where do people start? I mean, ultimately, people will start wherever they want to start, right? And I know most people just go straight to a broker and open an account, fund it, and start taking trades. That is generally the first place that people start. I would say read Way of the Turtle by Curtis Faith. That will open up your eyes. If you haven't read it, become aware of trend following. Everyone knows about day trading because it's everywhere. Swing trading, people are kind of familiar with it as well. Trend following is this art that has just been sort of buried under a lot of misinformation. So become familiar with trend following. That is really where I would tell people to start. Then also look at your numbers, work out a budget, reverse engineer your goals. If people reach out to me, I can send them a calculator on how to do this. Basically, we've created a calculator where you put in how much money you have, how much you want to earn over how long, and it will tell you your ROI at the end of it. You need to be making 15% a year, 20% a year, 30% a year, whatever. People reach out to me, I can send them the calculator. It's no problem.
Yeah, I will link this in the show notes.
Brilliant. Thanks, Wieland. Yeah. So I would say, look, work out your numbers, sit down with your partner, make sure that you and your partner are on the same page. Often people aren't. And again, that's because, the husband usually has a history of losing money. So he starts losing the wife on this journey. You've got to realign. You've got to make sure that you're on the right goals. I've been in this situation with several people over the last couple of years where they've been following me for a long time. They've liked my content. They see the truth and the value in what we're doing. They see our results. But because they've got a history of losing money, the wife has just gone, no, you're not joining Sublime Trading. You're not paying for that course because you're just going to lose it. So I don't blame her. But the flip side of that is, well, what is the alternative? Do you have another investing style that can deliver that kind of return that trend following can? And if you haven't got that alternative, then you've got to give trend following a go. There's no other option. You have to give trend, especially if you're going to have that shortfall in retirement. You're not on your path to your retirement goals. So, my advice to people is get your foundation in place. Understand trend following, look at your numbers, make sure you've got the right savings in place, get aligned with your goals and your family, with your wife. Take it from there.
Yeah. Thank you so much. So a lot of insights and a lot of ideas to follow, not just as a professional, also as a beginner. Also, if you're stuck a little bit with your time frame, if you're like, is this really the right one for me? How to manage my time, how to put everything into my day. There are solutions, and you just presented one of those. I really love that one. Thank you so much again, Zaheer, and I really hope to continue with you once in a while. It's always worth having a conversation like this. So really great. Thanks.
Wieland, appreciate it. Thank you so much. Really enjoyed that. Thank you.
That's already it, and I really hope that you enjoyed this episode and you took away some learnings for your personal trading. If you want to learn more about me, about my interview partners, if you want to have a one-on-one coaching or even get into a training course with me or my interview partners, just get into the show notes and follow one of All these links you find there, and then I will be happy to hear and see you again. Your Wieland Arlt.